Imagine turning $230 million into billions of dollars and then walking away. That's exactly what Warren Buffett just did with BYD, the Chinese electric vehicle giant. After 17 years of holding, Berkshire Hathaway has completely sold its stake. But why? Let's rewind the clock. In 2008, Buffett's Berkshire Hathaway bought about 225 million shares of BYD for $230 million, roughly a 10% stake. That deal happened because Charlie Munger was blown away by BYD's founder, Wang Xiangfu. At the 2009 annual meeting, Munger even called him a miracle, and the miracle seemed real. Over the years, BYD's share price skyrocketed more than 20-fold. At one point, Berkshire's $230 million bet was worth close to $9 billion, a 41% jump in just one quarter. But in August 2022, Berkshire quietly started trimming its stake. By June of last year, it had sold nearly 76% of its holdings, down to just under 5%. Now that number mattered because once Berkshire's stake fell below 5%, it no longer had to publicly disclose every single sale. Now fast forward to now, a new filing confirms it's over. Berkshire's BYD investment has officially gone to zero. The entire stake is gone, so the big question, why would Buffett cash out what some may call of one of the greatest investments of his career? Now Buffett hasn't spelled out the exact reason, but here are the possibilities experts and analysts point to. First, the most obvious one, profit-taking. Berkshire's $230 million grew into tens of billions. Locking in profits is classic Buffett, especially when future growth starts to look slower. Second, slowing growth at BYD itself. Domestic sales in China fell for 4 straight months. The company even cut its annual sales target by up to 16%, and quarterly profits dropped for the first time in more than 3 years. Third, fierce competition. China's EV makers are locked in brutal price wars, slashing prices to win customers. Beijing has even criticized automakers for racing to the bottom. Price wars must be great for drivers, but they crush profit margins. Fourth, portfolio rebalancing. Buffett himself hinted at this. He had once told CNBC, "We'll find things to do with the money that I'll feel better about." Around the same time, Berkshire sold almost all of its $4 billion stake in Taiwan Semiconductor, citing re-evaluated geopolitical risks. And that brings us to reason number 5, geopolitics. Geopolitical tensions between the US and China remain a significant consideration, and investing in Chinese companies carries more uncertainty than it did back in 2008. For a cautious investor like Buffett, that's enough to rethink an otherwise extraordinary bet. But here's the twist. Even as Berkshire exits, BYD still seems to be doing fine. Last year, it overtook Tesla in global EV sales for the first time. The company now has a market cap of over $137 billion, and its CEO, Wang Xiangfu, is one of China's richest men. But challenges remain. Analysts expect BYD to fall short of its 2025 target of 5.5 million cars, predicting closer to 4.7 or 4.8 million instead. What do you think? Did Buffett exit too early or right on time? Drop your thoughts in the comments below.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18, now streaming live 24/7 on YouTube.
Well, thanks so much for tuning in to CNBC TV 18. Make sure you follow us and stay updated on all our social media platforms.